All right, let's talk about IPOs, initial public offerings. It's a world that's just buzzing with energy, right? Big names, even bigger numbers, and this feeling that you're about to get in on the ground floor of the next huge thing. It's that moment a private company finally steps into the public spotlight, and for so many of us, it feels like getting an exclusive invitation to the party of the year.
Come on, you've heard this before, right? Maybe you've even thought it yourself. The news goes crazy, your social media feed blows up, and it creates this intense feeling of FOMO, that fear of missing out. The dream is pretty simple. Just land some shares in a hot new IPO, and boom, you're on the fast track to making some serious money. And you know what? That feeling, it isn't coming from nowhere.
I mean, if you look at the historical data, it's incredibly tempting. On average, here in India, IPOs have delivered a 17% return on the very first day of trading. Just let that sink in for a second. A 17% gain in 24 hours. That is an incredible lure, and it's exactly what fuels all that excitement. It feels like a sure thing, doesn't it? Okay, but this is where we need to pump the brakes for a minute. What if that initial price pop, that amazing 17% jump, is actually hiding something? A much more complicated reality. What if it turns out you're not just investing in a company's amazing future, but you're actually just funding someone else's past? To figure that out, we have to follow the money.
Now this right here is the absolute key. When you put your hard-earned money into an IPO, it can really only go to one of two places. Think of it like this. With a fresh issue, you're putting fuel in the company's gas tank. They use your money for growth, to build new factories, hire more people, innovate. But with an offer for sale, or OFS, you're not fueling the car at all. You're just paying the person who owned it before for their keys. Your money goes straight to the early investors who are cashing out.
So what about that awesome 17% pop we talked about? Well, research shows that most of it's not really about the company's true fundamental value. A tiny piece is the company deliberately pricing the IPO a little low, but the huge majority, almost 2/3 of that gain, is something called aftermarket mispricing. And that's really just a fancy way of saying pure market hype. It's the buying frenzy, it's the FOMO, all driven by emotion, not necessarily by solid business fundamentals.
So why is this so critical to understand right now? Well, because the whole game has shifted big time. In a recent blockbuster year for IPOs, a massive chunk of all the money that was raised, it never even reached the companies themselves. How big a chunk are we talking about? Well, take a look at this.
That's right. A staggering 63% of the money went straight into the pockets of shareholders who were selling out. Think about what that means. For the majority of recent IPOs, the main goal wasn't to raise capital for the company's future anymore. It was to create an exit event for insiders who wanted a big payday.
And look, this isn't some abstract theory. We're seeing it happen with huge, well-known companies. Hyundai's recent IPO, 100% an offer for sale. Not one single rupee went to the company for its operations in India. Same story with Vishal Megamart. And for others like Swiggy and FirstCry, a huge 60% of the money raised was just to cash out early investors. So you have to ask yourself, when the insiders, the people who know the business best, are all rushing for the exit, what does that tell you?
And there's another little trick at play here. It's called the low float illusion. See, after an IPO, the founders and the early investors have to wait through a lock-in period. They can't sell their shares right away. This creates an artificial shortage of shares on the market. You've got this huge demand from the public, all chasing a very, very small supply of available stock. So it looks like the market's saying, this company is amazing, is often just engineered scarcity pushing the price way up.
This timeline really shows you the insider's playbook perfectly. It's a well-oiled machine. They get in years ago for pennies on the dollar, then, right before the IPO, a massive hype campaign kicks into high gear. On listing day, that low float illusion we just talked about drives the price sky high. And then, once their lock-in period ends, they're free to sell their huge number of shares at that inflated price, which often floods the market and causes the price to drop for everybody else.
Now, an IPO that's mostly an offer for sale is perfectly legal, even if it feels like it's in a bit of a gray area. But there is a much darker, totally illegal version of this whole thing, the pump and dump scheme. This is just straight up fraud. It's designed to do one thing: artificially inflate a stock's price so that insiders can dump their shares on everyday investors like you and me.
And the playbook for it is actually deceptively simple. First, the scammers buy up a ton of shares in a small, unknown company. Second, they unleash a storm of fake hype. They use social media, spam emails, fake expert tips, anything to create a buying frenzy. Third,
Retail investors get caught up in all that excitement and start buying in at those super high prices. And then finally, the scammers dump all of their shares at once, crashing the price and leaving everyone else holding the bag.
So I think it's time we start to reframe how we think about this. A huge price pop on listing day doesn't automatically mean a company is a guaranteed winner. So often, it's just a reflection of good timing, that engineered scarcity, and a whole lot of market hype. The real verdict, the true story of an IPO, well, that usually doesn't show up for months, long after those lock-in periods are over and the real supply and demand kicks in.
So how do you protect yourself from all this? Look, this isn't about avoiding IPOs completely. It's about becoming a smarter, more empowered investor. So here's a quick toolkit. First, before you invest a rupee, check the OFS percentage in the IPO document. Is the money for growth or is it for an exit? Second, read the use of proceeds section. What is the company actually going to do with any money it raises? Third, pay very close attention to what happens when that lock-in period ends. And finally, always question where the hype is coming from, especially on social media. In the end, it all comes down to asking yourself one simple but incredibly powerful question before you invest. Are you funding this company's future, or are you just funding someone else's exit? If you can learn to look past the hype and really focus on where your money is going, you can make sure you're investing in a business you truly believe in, not just paying for someone else's ticket out the door.
Let's discuss that in the comments section. And as always, thanks for watching Alux Live. Subscribe for more.